Hi everyone, welcome back to my YouTube channel. Before we jump into today's video, don't forget to subscribe, hit the like button, and share this video with your friends if you find it useful. Disclaimer: this video is for educational purposes only and meant to keep you updated on stock market news and daily developments. I'm not a SEBI registered advisor or research analyst, so please consult a certified financial advisor before making any buying, selling, or holding decisions. Also, don't forget to join our free Telegram channel for more real-time updates on the stock market. Now let's begin with Today we are going to decode complex finance and economic updates in a super simple way. Today, we've got an important headline coming straight from the Reserve Bank of India, RBI, and it's actually good news for the Indian economy. Let's break it down together. So here's the big news. India posts current account surplus. What does that even mean? In the January to March quarter of 2024-25, India recorded a current account surplus of $13.5 billion. That's 1.3% of our GDP. Now wait, you might be wondering, what's a current account surplus? Let me explain simply. When a country earns more from exports and remittances than it spends on imports and other foreign payments, it records a surplus. It means we earned more than we spent internationally. Just a year ago, during the same quarter, we had a surplus of only $4.6 billion. And in the quarter just before this, we were actually in a deficit of $11.3 billion. So yes, this is a strong comeback for India. So, what helped India post this surplus? So why did this happen? What worked in our favor? First, boom in services exports. India made a lot more money from services like IT, business solutions, and software exports. In fact, net services receipts rose from $42.7 billion to $53.3 billion compared to last year. Second, more remittances from NRIs. The money sent home by Indians working abroad, also called personal transfer receipts, jumped to $33.9 billion, up from $31.3 billion last year. Third, lower investment income payments. What we pay to foreign investors for their earnings, called primary income outflows, went down to $11.9 billion compared to $14.8 billion last year. So, in short, we earned more and spent a bit less. That's how we landed in surplus territory. But what about the trade deficit? Now, here's the flip side. Our merchandise trade deficit, which means the difference between imports and exports of goods, stood at $59.5 billion in this quarter. That's higher than last year's $52 billion, but much better than $79.3 billion in the previous quarter. So yes, we're still importing more than we export in goods, but the gap is narrowing. What's happening in the financial account? Let's now talk about foreign investments and foreign exchange reserves. 1. FDI, Foreign Direct Investment. FDI inflows dropped big time. We got just $400 million this quarter, compared to $2.3 billion in the same period last year. 2. FPI, Foreign Portfolio Investment. FPI was also weak. Instead of inflows, we actually saw an outflow of $5.9 billion. Last year, in the same quarter, there was an inflow of $11.4 billion. 3. Forex reserves still grew. Even with lower FDI and FPI, our foreign exchange reserves still increased by $8.8 billion. Though that's less than the $30.8 billion growth last year, it's still a positive sign. What about the full year picture? Okay, so we saw a quarterly surplus, but what happened across the entire financial year 2024-25? Well, here's the summary. 1. Full year current account. Deficit of $23.3 billion, that's 0.6% of GDP. But still better than $26 billion deficit in 2023-24. 2. FDI for the full year, only $1 billion, way lower than $10.2 billion last year. 3. FPI full year inflow, $3.6 billion, also much lower than $44.1 billion in FY24. Final thoughts. So what does this mean for you? So here's the simple takeaway. 1. India had a surprisingly good quarter thanks to strong exports of services and rising remittances. 2. Trade deficit is still a concern, but it's reducing. 3. FDI and FPI numbers are low, something to keep an eye on. 4. Overall, the external situation is looking more stable, and that's good news for the rupee, markets, and the economy. So, that's it. Thanks for staying with me till the end. If you found this helpful, please like, share, and subscribe for more such updates. And don't forget to join our free Telegram channel for instant stock market alerts and insights. See you in the next video.